Hello, everyone. Welcome to today's partner webinar between Foundation Software, Payroll for Construction, and the Contractors Plan provided by Fringe Benefit Group. Today, we're going to be discussing how to streamline your payroll with the Contractors Plan, Foundation, and Payroll for Construction. Looking at our attendees, we got a decent amount have joined us so far here, but we're going to give everyone a few moments to go ahead and file in, and then I'll be back within in a moment to get things started here. But thanks again for everyone taking the time to join us for today's webinar. All right, looks like we had a few more filing in here. Probably going to have some others join us while we're still going. But again, welcome to today's webinars for those that are just joining us here now. Today, we're going to be covering how to streamline your payroll with the Contractors Plan, Foundation, and Payroll for Construction. My name is Alex Gray here, one of the regional sales managers at Payroll for Construction Foundation Software. I'm also joined today by Nat Peniston with the Contractors Plan. Going to put our contact information up here in a moment. If anyone is interested in discussing Foundation's full job cost ERP accounting stack package or Payroll for Construction's payroll processing services here, feel free to reach out to myself. Then Nat's going to be discussing how the Contractors Plan, what they have to offer when it comes to fringe benefits, optimizing fringes to help your team save money on projects, and have his contact information here. We'll also bring this back up for you guys here towards the end of the webinar here today. But without further ado, we'll go ahead and jump into things here for today's presentation for you. So I'll give more of an overview on how the Contractors Plan works with the Foundation / Payroll for Construction databases here. But for the flow chart, those that are on here that are maybe Foundation job cost ERP accounting clients processing payroll in-house through that Foundation system, or we might also have Payroll for Construction clients, those that are using Payroll for Construction as a standalone payroll processing service, processing their payroll inside Payroll for Construction, then integrating that with their own accounting package. Both of these are going to relate to you today, whether you're, again, processing that payroll in-house or utilizing Foundation's built-in payroll service, Payroll for Construction. This is going to be able to integrate, work with the Contractors Plan for your team, where inside those systems, Foundation or Payroll for Construction, you're going to go in, the employer will record the hours that are worked, the prevailing wage rates, as well as the fringe rates inside the Foundation's or Payroll for Construction payroll module in that payroll database. After payroll's then submitted over to our team, you submit that certified payroll inside that database, which is then going to generate paychecks as well as fringe deductions. And with that powerful payroll module for Foundation software, Payroll for Construction, with us being partners of the Contractors Plan, it's going to take that fringe information and create a configured file that the system would then save. You export to your system, log into the Contractors Plan, select that file that was created by our system for you, and your fringe information is then sent over, configured how the Contractors Plan needs that information. So with us being partners of the Contractors Plan, the whole payroll process is going to be streamlined, with our system going to be able to handle that complex prevailing wage payroll with the complex wage rates, fringe calculations inside our system, Then with you guys working with the contractors plan to help optimize those fringe benefits to help you save money, we'll be able to pass over that fringe information with us at Foundation Payroll for Construction being direct partners of the contractors plan. Now, I'll pass it over to Nat here in a moment, but to introduce the contractors plan, who they are, what they do. The contractors plan this year is celebrating their 40th anniversary this year. They designed, administered, and provided compliance, guidance, and hourly employee benefit programs for government contractors operating under that Davis-Bacon Prevailing Wage Act and other prevailing wage laws. So they offer products from the nation's leading carriers and are known for their prevailing wage expertise, integrated with a full service suite of online tools and services that greatly reduce your burden of plan enrollment and administration. And again, with us, Foundation Payroll for Construction, we're able to create a file for you guys to then pass back into their full service suite of online tools and services for you to help streamline that payroll process. Now, before I turn it over to him, a little bit more information about Nat, who will be giving his side of the contractors plan here. Nat is a nationally recognized expert in employee benefits with over 20 years of financial and insurance industry experience. Over the last decade, Nat has been the vice president at the contractors plan, the industry leaders in designing, implementing, and administering prevailing wage bona fide benefit plans for contractors. With Foundation Payroll for Construction here, we have been partners with the contractors plans for over a decade now. I've been working with Nat for a number of years and his team there. Can only say great things about Nat and the contractors plan, but without further ado here, I'll go ahead and pass it over to Nat, and I'll be back with you guys here a little bit later on in today's discussion.
Thanks so much, Alex. Great to be with you and with everyone who's joining today. So quick overview of what we're going to discuss today. Give you a little bit of history about the Davis-Bacon Act, where this law and legislation came from, why you should be doing prevailing wage if you're not doing it. If you are doing some of it, we're going to show you some opportunities to get more efficient and effective and do more of it. How the wage determinations are made, which prevailing wage regulations apply, certified payroll, which is obviously a key piece to all of this, what that means and where it comes from, and then as Alex mentioned at the end, he's going to go through that in a bit more depth, actually demoing Foundation's capabilities, where to find prevailing wage rates, and some best practices, especially around bona fide benefits. So without further ado, quick disclaimer, this is not tax or legal advice. I'm not an attorney or a CPA. This is meant to be informational. Everything that I'm going to discuss is verifiable with a quick Google search, and happy to put you in touch with accounting or tax or legal professionals if your specific situation requires. So this law that's been around for almost 100 years was originally had to do with what today we would call a VA hospital out of New York, actually on Long Island. And what happened was an Alabama contractor, entrepreneurial contractor, bid on a project in New York and won. Low bid wins typically in public projects, and brought labor up from Alabama, and the local unions were not real pleased with that. They said, these are our tax dollars, we live locally, we have certain rules and regulations, and we really don't think the federal government should be funding a local project with labor from out of state. So that's really where it came from. Today, there are approximately half of the states have little Davis-Bacon laws or state prevailing wage laws that apply at the state level for state-funded projects. So a couple reasons why this is a real opportunity is the government, the federal government is just spending boatloads of money today. One of the major pieces of legislation was the Inflation Reduction Act, especially if you're in the electrical industry. There are tremendous opportunities. There's also with car charging stations and other clean energy there's solar wind projects. And basically the Inflation Reduction Act is interesting because it removes the incentives that were previously there and replaces them with the same incentives if you as a contractor pay prevailing wages and have registered apprenticeship as a part of that project. So 15% of the total craft labor hours of a project must be government registered apprenticeship programs. So even if you have a great training program internal to your company, if that training program is not a government registered apprenticeship program, then that would not qualify. So you're starting to see, because of these projects, the need for prevailing wage understanding and certified payroll and so forth apply to private projects for the first time in the nation's history. The other opportunity is obviously the infrastructure bill. So what we're talking about is over $550 billion of new additional spending over the next 5 years. That's on top of the roughly $1 trillion that already would have been spent. So you're talking about massive, I mean, billions with a B, for roads, bridges, major projects, public transport, airports, water, power and grid, those types of projects. And as already mentioned, electrical vehicle charging. We're going to have electrical vehicle chargers on every street corner with the amount of money that's being spent by the federal government. And all of this is happening as commercial construction is really hitting the brakes. I mean, here in Austin, there was a massive office tower, commercial office tower that was engineered, planned, permitted. They dug the hole and stopped. When that's happening in one of the fastest growing cities in the country, you know there's an excess of office space because the hybrid workforce that started with the pandemic is really persisting. People are not going back to the office full time, so we've got really an excess of office space, and office space isn't really being built at this time. So one of the most common questions I get is, okay, so there's this wage determination. What is it, and why does it exist, and how do they determine it, and so forth? So it's pretty interesting. I mean, originally there was not a Bureau of Labor Statistics when this law was passed, and so the way that these wage determinations are determined is very unscientific. It's duplicative and not really the best way to do it, but that's the way it's done today, which is a survey that goes out approximately 130,000 rates throughout the country. And the reason there's so many wage rates is because you're talking about 3,000 different counties and 4 types of construction. So building, so that would be like a commercial office tower. Heavy, which is basically the bucket that everything else that doesn't fit into the other 3 fits into. That'd be things like dams or something like that. Highway, which is pretty self-explanatory, and residential, which is pretty self-explanatory. You've got approximately 20 trades of craft workers, so electricians and plumbers and carpenters and roofers and so on. So you multiply all those up, and that's how you get to the 130,000. Now, who responds to these surveys? Well, merit shop contractors, non-union contractors, typically are focused on their business. They're not focused on filling out surveys. Part of it is there's no incentive to respond. Why spend the time? My time is valuable. And 2 is it's perceived to be difficult. It turns out it's actually not terribly difficult. And I would encourage the merit shop contractors out there to actually fill out these surveys. Just Google wage and hour survey, and it'll pop right up, and you basically put down the project and the wage rates that you paid and the fringe benefits that you offered and those types of things, and in one page you can fill out the survey. Unions are heavily incentivized to respond, and do respond, because the union fringe benefits go to the union. And so that's why, even though 14% of the construction workforce is union, 63% of the time union wage rates prevail. So which prevailing wage regulations apply? I mean, that's one of the most common questions and sources of confusion. And it's sort of like back to when Nixon was being investigated, is follow the money. Where did the money go? Is this federal money or is this state money? Is it dual? Is it state and federal? In many cases, there can be just a tiny bit of federal money, meaning a loan guarantee, a grant. There's this housing and urban development, community development block grant program. A lot of people don't realize, well, that's residential. It doesn't seem like it's federal. Well, no, there's now, it's a project cost over $2,000. It's getting some federal support. That's now a Davis-Bacon project. Under Davis-Bacon, overtime is over 40 hours per week, and it's only for base wages. So if you've got making this up, a $20 base rate and a $5 fringe rate, your overtime is time and a half on that $20, not the $25. And we're going to spend a good amount of time today on the certified payrolls. Those have to be submitted to the applicable contracting officer within 10 days after the payment of the wages. So questions, obviously I can't go through every individual state of those. I think it's 28 states currently. But the things to look at is, what is your project threshold? In some states it's very low, like in California it's very low. Other states like Maryland, I think, is $250,000. So what is the threshold where these prevailing wages are going to apply? What does it apply to? Is it construction, reconstruction, alteration, maintenance, demolition? And those are some of the common ones. What are the overtime implications? In Massachusetts, Pennsylvania, and Washington, if you include the fringes in the base pay, then that money is included in overtime. In most other states, California and others, even if you put the fringe into the base pay, meaning in the paycheck, that does not mean you have to pay overtime on it. So a lot of implications on a state-by-state basis, and happy to speak offline about your specific jurisdiction and projects that you're working on, and what rules and regulations might apply. So this is an example of the WH347. Notice that this is essentially a very specific, so you're looking at a specific minimum wage by craft and location. Some people get it confused by it's just craft, or it's just location, or it's a maximum, or various other points of confusion, but it is a specific minimum wage by craft and location. So an electrician in Travis County is different than an electrician in San Francisco County, is different than a carpenter in San Francisco, and so on. I know it's very small, but at the very bottom left of this page is a little checkbox, and it says where fringe benefits are paid to approved plans, funds, or programs. If you've already gone through the complexity of calculating the correct wage determination, meaning base wage and fringe benefit and the hours worked and all of that, you've already done all of the hard work, and you've done that hard work in the foundation system. Once you've determined that a specific craft worker is owed $872.50 of fringe obligations, putting that $872.50 into their paycheck versus into a bona fide plan is actually very easy and really pretty identical. And we're going to talk further about why it behooves you to put those funds actually into a bona fide plan as a union would, or a union contractor would. Interestingly, with the Inflation Reduction Act, you don't have the wage determination is actually in the bid. So you need to go out to sam.gov and plug in your location and county and building type, and then that will pop up a wage determination that looks something like this. This happens to be Cumberland County, and it happens to be an electrician, $35.25 of a base wage here, $25.98 of fringe obligations. We'll talk a little bit more about paid time off, but it's important to understand that President Obama put in place, and successive presidents have kept it in place, Executive Order 13706, which establishes mandatory paid sick leave. And because this is a mandate, you cannot reduce your fringe obligation by that mandate. So you have to pay, as an employer, that 56 hours of paid sick leave, and you cannot reduce your fringe by it. If your PTO policy is beyond 56 hours, you can reduce your fringe for that, but the mandate piece of it cannot be paid for by the fringe. Here's a specific state prevailing wage out of Pennsylvania, again, Cumberland County as an example. So you see there's slight differences, but very, very similar. So a couple of suggestions here. Contract language, assuming this is a Davis-Bacon Act, that specific language from 29 Code of Federal Regulations Part 5.5 must be in the bid. And it has to be in the bid between the agency and the prime, between the prime and all subs, between all subs and sub-tier subcontractors. Meaning, even if you're the 5th level subcontractor, that wage determination and language must be in the bid. Technically, if that language isn't in the bid, that you're due a change order. You can't have these rules and regulations be sprung on you, in other words. Another key point is posting requirements. So many states, this example is Pennsylvania on the top left, but there's also the Davis-Bacon posting requirement. In fact, it has to be 11 by 17. It has to be this exact format, has to include those wage rates. And frequently contractors are like, oh yeah, I got that in a binder in a truck. That is not okay, and you will be dinged by an enforcement officer who does an audit. In fact, I would not only post it and ensure that it's posted, but have a picture of it being posted so that you have proof that you fulfilled this obligation, because these employees have to know their correct proper pay rates. Another common question is, what happens if I'm doing a project that is going to last 18 months? Do I have to constantly check the wage determination to see if it's changed, or can I just use the same one as when I started? And by and large, you can use the same one that started. The exception to that is that if the wage rates increased more than 10 days before the bid opening, the agency must issue an addendum with those wage rates. Again, if the agency doesn't do that, that contractor is due a change order. So even if the project lasts 2 years, there's no change in wage rates over that 2 years, provided it doesn't meet this 10-day rule. Another best practice is update your contract language every single year to capture a constantly changing legislative and regulatory framework. Require all of your subcontractors to submit their certified payroll reports and their labor and compliance documentation, and include that right to request. If you don't have a, quote, right to request, unquote, canceled checks, time cards, etc., then it's really the subcontractor's discretion. You can't, as a prime or senior subcontractor, withhold payment. And I would just add that you can't withhold payment and not report it to the contracting officer. In other words, if you feel that a sub isn't doing the job right or isn't paying their wages or is under investigation, then the best practice would be to go to that contracting officer and say, I'm having a problem with this sub, or I don't want to pay this sub. I want to refund back funds that have been allocated, so that you don't get in a situation where the government has given you the funds, but now you're withholding the funds from the subcontractor. Another important point is to check eligibility of your subs. So there's a federal debarment list at sam.gov. Most states, like Pennsylvania's is here, have their own debarment list. And obviously, as a senior contractor or prime, you are liable for your subs and making sure they are not prohibited from working with you. So as I alluded to earlier, it's perfectly legal to pay the fringe obligation in cash in the paycheck. It's also costly, and it's also not the way the unions do it. If you're a union contractor and you send the fringe obligations off to the union, all of that is pre-tax, pre-insurance. So as a non-union contractor, if you pay your fringe obligations in the paycheck, now you're subject to unemployment taxes. Unemployment taxes for state and federal range, but a couple percent. Then you've got Social Security, that's 7.65% nationally, obviously it's federal. And then your insurance premiums. In 49 of 50 states, your work comp and general liability insurance premiums are based on your payroll. If you're increasing your payroll, your fringe obligations are now costing you additional money. And so overall, that's about 25% back of the napkin. That would equal, in most cases, about 4 to 6% of your overall payroll costs. So a pretty significant amount of money. Let's now look at this on a more numerical basis. Okay, so this is an example of an individual employee for a single hour. On the left, I've got a merit shop contractor not offering bona fide benefits, not paying the fringes into a bona fide plan, just paying the fringes in the paycheck. So I've got a base wage of $30, a fringe obligation of $10, gives me a total wage of $40. 25% of $40 is $10. So that gives me a total bid cost of $50. Now, obviously, it's more complicated than that. You've got overhead and other pieces that might go into your burden, but I'm just trying to illustrate the difference in the fringe obligation. So on the right, you've got a bona fide plan. This is what unions do. You've got a base wage of $30. You've got a total wage now of $30. Now 25% of $30 is $750. I still, as a contractor, must discharge that fringe obligation. So I've got a $10 fringe obligation, just as I did in the previous scenario. But now my total cost, 30 plus 750 plus 10, is $47.50. So that's a pretty significant savings. Here is an example using those same numbers for the contractor overall. So in this case, about a quarter of the contractor's labor hours are prevailing wage. Government gives us a safe harbor of 2,080. I know most craft workers aren't working a straight 40-hour-a-week, 52-week-a-year scenario, but we'll just use that. Times 25% is 520 hours. I've got 25 folks in the field. My hourly savings from the previous example was $2.50. 520 times 25 times 250, that gives me a total contractor savings per year of a little over $32,000. So pretty significant, even though you're talking about a fairly small, very typical subcontractor. Not only would you as a subcontractor save money, that money is going to accumulate over time. So that savings, you know, in most businesses, you're looking at kind of a 5-year budgeting cycle. And so it's not just the $32,500 this year, but it's, what is it next year? Well, that's 65, and then the year after 97. And so over a 5-year period, that contractor saved over $160,000. That's a pretty substantial difference in a net assets P&L type of perspective over a 5-year budgeting period. But it also benefits the employees. And so, you know, if we do a typical employee fringe contribution of $10,000 per year, we use a very conservative 5% annual growth rate. Historically, the markets have done more than double that, but let's just be conservative. Over a same 5-year period, that employee is now going to have over $55,000 in their account. So they're going to see the benefit of this pretty substantially as well. Okay, so I've mentioned bona fide a couple times. I also called it bona fide. A lot of people do. That's perfectly fine. That's the, I think it's Latin, fancy name for what does the government consider actually allowable. And the first is apprenticeship, and it must be a government registered apprenticeship program. Programs like the ABC apprenticeship program or an IEC apprenticeship program, those you can reduce your fringes by the cost of those programs. Note, like training, like a toolbox talk or other non-apprenticeship programs, you cannot reduce your fringe obligations. Paid time off, already alluded to that. I'm using this as a bucket of holiday, vacation, sick pay, etc. You know, each company can set those plans up differently. Just know that first 56 hours of sick pay at the federal level is required, and you cannot reduce your fringe obligations by that. And then the last two, health and welfare and retirement. Health and welfare being medical benefits, other insured benefits like life and disability and dental and vision insurance. And then on the retirement side, things like profit sharing plans and 401ks, those are very commonly where the majority of fringe benefit dollars are spent. If you were a union contractor, those would go into pension plans and health and welfare funds and so on. So what is the actual definition? Well, it's these 4 components. One, it must be specified. In other words, it has to be written and communicated to those covered employees. You can't just have a plan and not tell anyone about it. 2, it must be irrevocable. So these funds must be fully funded. The funds must leave the employer's account. The exception to that is paid time off. You know, a common error that I see is an employer has a self-funded plan and they take credit at the COBRA rate or some other rate, and meanwhile the funds have not left the employer's accounts. That is not acceptable. It must be specific to each employee. So between foundation software or a firm like ours, those dollars must be accounted for down to the penny per hour and provide a benefit directly to the skilled worker. And so hourly, each employee, written and communicated, and irrevocable, meaning the funds have left that employer's operating account. Those are the key criteria. So retirement programs have a number of opportunities for contractors. First, you can contribute on an hourly basis quite easily. And in fact, employers have the opportunity to determine their contribution by job class or job site. So to use a couple of examples, if you've got a school that has a fringe of $20 and you say, I want to give my employees half of the fringe in cash, so I'm going to give them $10 in cash and $10 in a retirement program, you can do that. You could also do it by job class. So you could say electricians get $10 in cash, $10 in a retirement program. Laborers get all $15 of their fringe in a bona fide program. So you've got some flexibility there. It's important to remember that these are employer contributions. These are not elective deferrals. Employee choice is not required. So what I see out there a lot is that employers are taking credit for their match of their elective deferrals. So they've got a 5% match. Let's be generous and use an even number. Let's say the employee makes $100,000 a year. They've got a $5,000 5% contribution, and then the employer reduces their fringes by $5,000. While that's legal, that's not a lot of money. And you're now tying it to the employee choosing to defer 5%, as opposed to saying, no, you have $10,000 of fringes. I'm putting all $10,000 of your fringe obligation in this retirement program. It's important that this program be 100% vested. Where I see contractors run into challenges here is that they have a vesting schedule with their 401k. And so it's something like, you vest 25% each 12 months over a 4-year period. And that is not okay. You now have a vesting schedule tied to the fringes. If the employee leaves, those funds revert back to the employer. That's the whole point of a vesting schedule. And now you're out of compliance because those contributions must be irrevocable. So you can set up a standalone profit sharing plan or a 401k, meaning you can have fringes only flow into that plan, or you can have it in conjunction with elective deferrals, up to the owner and the company to determine, is this going to be a fringes only plan, or am I going to do more of a traditional 401k with elective deferrals plus fringes? And we're going to talk about a couple of opportunities that owners and highly compensated employees can benefit through the plan design and utilize those fringe obligations to help their own contributions. And it's important to note, and we're going to talk about annualization if folks aren't familiar with that concept, but retirement programs with essentially immediate vesting, less than 500 hours, are not subject to annualization. In other words, it's like a faucet. When there are fringes, you put fringes in the plan. When there are no fringes, you don't put fringes in the plan because there are no fringes. So if you were to have a profit sharing plan, what would be very common is to say, we're going to give everybody 10% of their overall compensation in a discretionary profit sharing program. And so for that owner that makes $305,000, 10% would be $30,500, and on down to employee 12, 10% would be $6,400 and change. Well, what you can do as an employer is actually offset or even separate out those employees with prevailing wage fringes and say, you've already met your profit sharing contribution with those employer dollars of your fringe obligation. And so you don't have to pay them anything. Now, that's not to say that you couldn't add more, but you don't have to pay them more. Then you have non-prevailing wage employees. Let's look at employee 4 in this example. You've got a $113,000 employee. They're maybe your most successful employee, but they're a former felon. And therefore they can't get on the military base where you do a lot of work because they can't get a security clearance. Well, now you can reward that employee because they're a great employee with a pretty significant profit sharing contribution because that employee is valued and they're not able to do prevailing wage. But then most importantly, look at the amount that the owner and spouse and child can all benefit from this plan, over $118,000, that if you were to make contributions otherwise, then you wouldn't have enough funds to have such a significant contribution to that owner. Another example is what we call the boost, which is basically in construction. Unfortunately, a lot of craft workers don't feel the need to save for retirement, even though they should, and even though who knows if Social Security will even be around. They're kind of living for today. And so if the employees themselves don't defer, then the owners can't defer, and it's almost like, why even put in place a plan? But in this scenario, we're now using $300,000 of prevailing wage contributions. We're now able to maximize up to the legal maximum of $22,500 the highly compensated employees of the owner and manager for their own plan. So I mentioned annualization. Annualization does not apply to retirement plans that are immediately vested. It automatically applies to all insured benefits. Think health insurance, dental insurance, vision. The easiest example is life insurance. I want life insurance all of the time. There's never a time when I don't want life insurance. So I have to pay for it for all hours worked. And so the way that you as a contractor arrive at the amount to be annualized is that you take the total cost. In this example, it says $6,000. Maybe that's $500 per month times 12 months of health insurance. You divide that $6,000 by 2,080 hours. That gives you $2.89 per hour that you can take credit. So in my earlier example of a $20 fringe, it'd be $20 minus $2.89, and then the remainder of that would flow to the paycheck or vested retirement. Note that the employer must come out of pocket, essentially pay that $2.89 for every hour worked. So even if they're now on a private job, there is no fringe, $2.89 every single hour. Overtime, weekends, it's a blue moon, doesn't matter. Always $2.89 per hour. So hour banking is something that is really impactful for folks that have a lot of seasonality. So we have a lot of clients up in Alaska, for instance, and they really only work about 4 or 5 months of the year, and especially if they're obviously if they're outside. So in that scenario, what you're doing is you're essentially creating like a savings account, and you're banking the excess hours. So in this example, in July, this craft worker worked 160 hours at a rate of $3 per hour. The premium submitted for their health insurance and other benefits was $480. Because that threshold was 130 hours, because they worked 160, they now banked 30 hours or $90. Same thing occurred in August. Now they worked 180 hours. Again, only needed 130 hours. Now their bank is up to 80 hours or $240. And then in September and October, they worked fewer than 130 hours. So now they're drawing down from the bank. So now the employer isn't coming out of pocket to pay for hours when they're at a slack work period. So I know the number one concern employers have about putting fringes into benefits is, what are my employees going to think? But if it isn't even right for you as an employer, we don't need to get there. So let's deal with, first and foremost, is this right for you as an employer? First and foremost, you're going to be more competitive and or have higher profits. In other words, if you're already winning bids, then that 25% that we talked about on those fringes, that 4 to 6% of payroll, that's going to drop to your bottom line. If you're not winning bids, it's likely because union contractors and other merit shop contractors are not paying the fringes in cash. And so it's putting you at a disadvantage. Essentially in construction, I mean, you've got 3 main buckets that go into your bid. You've got your wages costs, you've got your materials costs, and you've got your overhead and profit costs. Can you reduce your overhead? Not really. Can you reduce your profit? Sure. Do you want to? Probably not. Can you reduce your materials costs? Probably not. I mean, if you're an electrician, you're probably getting your Romex for the same price as everybody else. And so your wages under prevailing wage by definition are set. And so now you're really putting yourself at a disadvantage. It's also going to free up your cash flow. So if you pay those fringe obligations in the paycheck, well, then you have to pay it in the week that the work was done. Then that goes on that certified payroll. However, if you put it into a bona fide plan, the government gives you 90 days to pay that into the plan. So we wouldn't recommend you wait until the 89th day, but if you waited 60 days, you may well have, and probably should have been, reimbursed for that work. And so now you're going to free up that cash flow, the amount that you would have come out of pocket before the government reimburses you for the work. It's also going to equalize wages between public and private work. In many states, the base wage alone is higher than the equivalent private wage. So private work, I might typically pay an employee $45 an hour. I walk across the street and I'm working on a school. All of a sudden, now I have a base prevailing wage of $50 an hour. That's very common. Forget the prevailing wage on top, or the fringe obligation on top of that. Fourth, you're going to have meaningful health and welfare benefits. There's a reason every single one of the Fortune 1000 offer benefits. It's because it's a great way to recruit and retain employees. Once employees see that they have a retirement program, they see that they have health insurance, they're using those benefits, they're much, much less likely to quit, and they're much more likely to join your firm. It's one of the reasons why craft workers join unions, is that they want those health and welfare benefits. And it's going to equalize your footing against those unions, because now you're going to have benefits of a comparable nature. And as we talked about, you can increase retirement savings for owners and other highly compensated employees. And perhaps most importantly, it's really simple to administer, especially with foundation software doing all of the heavy lifting of those calculations. Now you've determined the amount that needs to be contributed, and you simply upload a file, and you're making that same contribution minus the taxes and insurance premiums and so forth. So how do we get employees on board? Well, we have to enroll them. We have to treat them as partners, as engaged employees that we respect. And so we need to enroll them. We need to communicate with them why we're doing this. And first and foremost, the company needs to be competitive to win these jobs. You're not likely to win these jobs that its lowest bidder wins without you're putting yourself at a 4 to 6% labor cost disadvantage versus the unions and other merit shop contractors. Two, if Congress just wanted a higher base wage, that would have been a whole lot easier. Fringes were designed to be used for benefits. That's what they are intended to go to. And if you were a union contractor, that's where they would go. So this idea that, no, I need the money, really isn't applicable. In many cases, the wages, as mentioned, are higher on prevailing wage than private work to begin with. And you're going to provide those meaningful health and welfare benefits pre-tax and 100% vested. So it's not like you're holding on to these funds. These funds are going in, and now that employee is getting all of that money. So if there were a $20 fringe obligation, if you pay that in the paycheck, the employee might get $13. Why 13? Because they've got to pay FICA, they've got to pay income tax. They're not getting 100% of it. But now this goes in 100% pre-tax. That's their money. If they leave you for whatever reason, those funds are vested. Those are their funds. And if you as an employer permit, your employees can take loans against their retirement account up to 50% of the value of the account or $50,000, whichever is less. And so that can help these employees bridge the gap between I don't have any savings and therefore I can't save. So with that, let me turn it back over to Alex, and hope this has been real helpful in going through these points.
Stuff there, Nat. Thank you for that. All right, wonderful, everyone. So I had started sharing my screen here now to talk about how we can streamline the entire payroll process for you. So with Nat, the contractors plan, being able to help optimize those fringe benefits to help you and your team save money on those projects. Now let's talk about how to do the heavy lifting. So a lot of information we need to track with that fringe information, and with those that are looking for a full job cost ERP accounting software, with Foundation software here, have that payroll module available for those that want to run their own payroll in-house. Allows you to enter time cards, pay the employees, upload the direct deposit file to the bank, run that payroll in-house through the Foundation system here, or also through Foundation. Maybe you're not looking at switching accounting systems. You're looking to still streamline that payroll process. With Payroll4Construction, Foundation's sister company, a full payroll third-party provider that can process the payroll, pay the employees via check, direct deposit, automate the tax filings and payments, having our team handle those as your payroll service provider. You can also stand alone here or directly integrate into that main Foundation accounting package that I'm shown here. But regardless whether you're using us to process payroll in-house or using the Payroll4Construction third-party payroll service here, both are built on that Foundation accounting package here, where with a powerful payroll module inside the system, inside payroll maintenance, we're going to have separate tables that allow us to set up those wage determinations for that Davis-Bacon prevailing wage rates, as well as track that fringe information, throw them into the correct buckets that you need to track the information to then send over to the contractors plan. So with those wage determinations for that prevailing wage, that Davis-Bacon job, go ahead, set up those rates inside the system here based on the classification, what our employees need to be paid. Then with these tables and that fringe information, we're able to then tie them to that specific job inside the system, where when we code time to said job, based on our workers classification, going to pull in the corresponding rate of pay, as well as on a separate table behind the scenes, we're going to then set up that fringe information, those fringe benefits, to what buckets they need to go in per your plan with the contractor's plan, where, hey, whatever buckets they need to go in here, we'll get them set up of how they need to be calculated inside the system. With Foundation, Payroll4Construction, we have been partners again for over a decade with the contractors plan. So you'll get an assigned implementation specialist for your team that's going to build this database to only house the information that you need for your payroll runs. They'll be able to work with what you guys are doing with the contractors plan, set up those fringes to go in to the correct corresponding buckets, how they need to be calculated. You can also control how these are taxed, and can even set up limits if we have any caps to a 40-hour limit for specific fringe benefit inside the system. So with the payroll module inside our system, we'll get this mapped out to where your team then comes into the system, codes your time into that actual database. And again, if we offer our own mobile applications here, but if anyone's using a mobile application for their team, can set up a time card import to bring those hours into the system, then have a number of reports to run to check where we stand with those payroll runs, the calculations, before you submit it over to our team for payroll processing. Then with, again, that Foundation ERP accounting system, you can go ahead, pay your employees in-house there, but those that are maybe looking to outsource the burden of that payroll to our team, once you submit payroll to us, Payroll4Construction can pay the employees via check or direct deposit, handle all tax filings and payments as your payroll service provider, the weekly, monthly, quarterly, and annual tax filings for any federal, state, local authorities, FUTA and SUTA, as well as year-end W-2 distribution for the employees. So our team would get all payroll history, what has been done so far this year, up to date inside your system. So employees would only receive one W-2 from Payroll4Construction come year end. Then After that payroll's been processed by our team, we need to then get that fringe information over to the contractors plan, where with us being direct partners of them, we'll have a configured file that implementation specialist will set up for your team to run, where you're going to export that fringe information. We'll get that mapped out with your contractors plan ID, and then also save how we need this report to be ran to then pass over into their online service portal, where your team then runs the report. The system then pulls all fringe information based on those runs per what has been submitted to us through the system and automatically tracked for your team. Then all you'll need to do is click post. The system creates a file that you export to your desktop, log into the Contractors Plan online service portal, upload that Contractors Plan fringe benefit file. Your fringe information has then been tracked, automated for you by the system here, and then that fringe information is already configured to be passed over how the Contractors Plan needs that information. Then what else makes us different here? With that payroll module, after payroll's processed, and we're having this public work, that prevailing wage Davis-Bacon work, where that certified payroll reports that had covered during his portion here need to be generated and submitted for said project. So with our database, our system here, no matter if you're running print versions or running electronic certified reports that were uploaded to the LCP tracker, DIR, Ashware, etc., our system's going to be able to create those reports for you. If there's a spot for it on the certified, there's a spot for it to be tracked inside of our system. And with those print formats, gonna have over 40 plus state and federal specific formats available inside the system. We'll just scroll through for those on the call here today to show what we have available inside the system. If anyone has any questions, we'll be happy to discuss your specific agency format with us. And with our team, we're only working in the construction industry here. So if a format changes, our team will get that format up to date for you as a foundation or payroll for construction client here. The number of formats available here. The main one that I'll show, that federal WH347 here, and have the defaults get that formatted to what we need to pull into that certified report, and also going to be able to generate that signature page. And Nat had also discussed, hey, you're working with the contractors plan, those fringe benefits are being paid through approved plans. That checkbox can have that checked by default on the report where your team runs it. Going to then generate that certified report based on what was pushed through the system for payroll. Automatically pulls in all information. Again, if there's a spot for it on the certified, there's a spot for it to be generated and tracked inside of our system. No manual entry on that certified report. And again, also we'll even generate that signature page for you, have that checkbox checked that you're working with the contractor's plan. Then can PDF pull that certified payroll report outside the system. The legwork has been completed for you, automated by our powerful payroll module inside Foundation or inside your Payroll for Construction system. Then the last format that I'll cover here, like any contractors on here that, again, working with electronic portal uploads online for those certifieds, maybe the California DIR, Ashware, the state of Maryland. Formats available inside the system here, or another big one, that LCP tracker. Select your electronic format that you need, click OK. Come up, put in the date range, define where you want this to be saved on your computer. Now, with this report, we are having the system create the XLS file upload for the LCP tracker. So all you need to do is run said report. Now, looks like a jumbled mess of information here, and that's because we're creating the file upload for LCP or whatever electronic portal you may be utilizing there. Click close. System says file has not been created. Create file now. You click yes, save it to your desktop, log in to your online portal for your certifieds. You upload said certified report file that was generated by our system. Your certified has then been completed by Foundation or Payroll for Construction, whatever you may be utilizing the payroll process for here with our team. And with our payroll service here, or also the full job cost ERP accounting system, number of job cost reports, construction specific reports that will be available, generated inside the database here, with you guys utilizing us as your potential payroll provider or our system running payroll in-house there. But what I'll go ahead and do here now is I'll open it up to questions here and invite Nat to join me again if anything else may come out here. But pull up our information here. If anyone is interested in setting up a demonstration of Foundation's job cost ERP accounting system or Payroll4Construction's payroll processing system database, feel free to reach out to myself, or if anyone is interested in receiving more information from Nat and the Contractors Plan, have both of our information here. But we'll give everyone a moment to throw some questions in the chat if there's anything else that we can help on the call here today. Looks like we had someone say maybe get a copy of the presentation. Yes, we'll be sure to get you a copy of the presentation for your review. We'll have someone reach out to you and give you that copy after we hop off here today. Then not seeing if we have any other questions here. Nat, not sure if you can see questions on your end. Looks like one for you here. I can read it to you if you can't see it there.
If you wouldn't mind, that would be great. I'm actually having a little bit of trouble seeing it.
Yeah, not a problem. So one attendee asked, our state prevailing wage does not break out fringe versus base wages. How can we determine that? Then also said the state of Michigan there.
Got it. So typically there's a percentage that can be determined based on what the basically using union information, and we can be happy to discuss that offline with you and determine that scenario. That's while not super common, it does happen in a number of states, Michigan, Missouri, and a couple of others that just have a single rate, and you can determine that fringe amount, but it does take a little bit of legwork to determine.
Perfect, great stuff there, Nat. And we'll put you in contact with Nat to further assist if you have any additional questions to help with there. And did see some others in the chat say they would like copies of the presentation. We'll be sure to get that out to you there. But with that, I want to wrap things up here. Nat, thank you again for your time here today. Love the continued partnership between Foundation, Payroll4Construction, and your wonderful team over there at the Contractors Plan. Really appreciate your time here today and everyone else taking the time to join us today.
Great to be with you, Alex. It was a pleasure, and wish everyone else a great rest of the week.
All right, wonderful. Goodbye now, everyone.